All right, so tonight we're going to talk about management teams, financial projections, returns, and give you some tips on crafting your investment deck, and then review deadlines and deliverables. And then we're going to open up a handful of breakout rooms with current UGF associates. So if your team wants to hop into one of those and get feedback on anything that you're working on, we'll have that available, and then we'll close out the evening. So, deliverables. You need to prepare a 10 to 15 slide presentation plus appendices that cover the offering. So what are you buying? Description of the business and strategy, management team assessment, market analysis, competitive landscape, historical and financial projections, your exit strategy and projected returns, and then rounding it out with your investment thesis. Why you believe it's a good investment. You should plan on about 10 to 15 minutes to present and 8 to 10 minutes of Q&A if you're selected to be one of the finalists. So hopefully that gives you a rough idea of what the deliverable looks like. So it's just a presentation, but it should be a very content-dense presentation. And don't be afraid to have a high number of appendices. In fact, for the initial presentation, initial deliverable, you don't even need to throw everything in the appendix if you don't want. You can put it all in the presentation and have a much longer presentation if you so desire. But for the final deliverable that will go in front of the judges, the investment committee, if you will, you'll probably want to keep it to 10 to 15 slides with the rest in the appendix. Any questions on that? All right. So the offering. Well, the first thing you got to figure out is, what are you buying, right? Are you buying debt or are you buying equity? And how much are you paying for it? So as an investor, you're either basically investing equity or debt or some combination in the middle. So just some terms that we're going to review really quick for all three different things. So the first one, for equity, there's going to be the valuation. So you're going to need to explain the valuation of the business. What the business is worth when you're making the investment is the pre-money. And then you basically take the money that's being invested, the total amount, and add that to the pre-money valuation, and that gives you your post-money. The idea behind this is, you're going to a company and you're saying, okay, what is the company worth today? If I bought the whole company, what would it be worth? That's your pre-money valuation. And then the assumption is, okay, now I'm going to give that company, like, let's say $1 million. Let's say I say the company is worth $10 million today. If I were to buy the whole thing and I just wanted to own all of it, it'd be worth $10 million. And if I give them $1 million, well, then it's presupposed that they didn't destroy that $1 million the moment I gave it to them. They still have it and it's still worth at least $1 million. So the value of the company just went up by $1 million, and that gives you your post-money valuation. Okay. So you're going to need to include those. That in turn implies an ownership percentage of the company, right? So if I invest $1 million at a $9 million pre-money valuation and a $10 million post-money valuation, I will own 10% of the company, right? So that's helpful to know. The next thing that you're going to want to talk about is there any sort of downside protection, like a liquidation preference? So oftentimes what happens in venture capital is that we invest in what's called preferred stock. So there's two kinds of equity. Generally speaking, you have common equity and you have preferred equity. Common equity is what everybody has in the company. Like all the employees, management team, all that, it's treated the same for everyone. That's why it's called common. Then you have preferred equity, which the way to think about it is that preferred equity holds certain rights and privileges and responsibilities with it and it is not shared with, and those rights and so forth are not shared with everyone. They're not common. They're preferred to those people that hold those shares. Venture capitalists tend to invest in companies with preferred shares. And the reason they do that is there's many reasons, but probably the biggest reason is that it gives them downside protection and it gives them control. It gives them the ability to have more control over the company than their ownership percentage would otherwise allow. And it provides them some level of downside protection when things, should heaven forbid, things not go well with the investment in the company. So on the control side, preferred investors may have things like, you have to get our approval before you sell the company. Even though we only own 10% of the company, you still have to get our approval before you sell it. Or you have to give us notice if you're going to hire somebody and pay them more than a certain amount, and give us the ability to approve that. Or anytime you give stock to somebody else, you have to get our approval, right? So there are a lot of different controls that are put into place, and usually they're put there as another way to provide downside protection for investors. Now, the way a liquidation preference works is it kind of provides almost debt-like protection to equity holders of preferred stock. So let's say I have a 1x liquidation preference. What that means is when the company sells, I'll have a choice. And I can either convert my shares from preferred shares into common shares and participate alongside everybody else, or I could keep my preferred shares and get my original investment back, or get paid back my original investment first before anybody else gets paid. So the way that would work is, let's say, going back to my example, my $9 million valuation, and I invest $1 million, right? Well, if the company sells for $20 million, I own 10% of the company. So my stake, I originally invested $1 million, it's now worth $2 million, right? So in that scenario, I would want to convert to common and end up owning 20% of the company and getting my $2 million. What happens if the company sells for $5 million, right? It's a negative outcome. Well, in that case, my ownership percentage is 10% of that still, right? So $500,000 is what I would get back. But I have this liquidation preference that says that I will get paid back my $1 million first before anybody else gets any money, as long as I maintain my preferred shares. So in that scenario, I would not convert to common. I would stay as preferred shares, and I would demand my $1 million investment back through the liquidation preference. If that makes sense. Now, these liquidation preferences, they can come in a lot of different shades and shapes and sizes. You could have a 1x liquidation preference. You could have a 2x, a 3x. You could have what's called a participating preferred preference. So the way that works is you get your cake and eat it too. You get your money back, and you can convert to common and get your 10%. So in that case, even though the company had a bad outcome, you still made money on the deal because you got your $1 million back, and then you got 10% of what was left, so another $450,000. Those are less common and not very entrepreneur friendly, but they do happen. So yeah, so if you're investing in equity, you want to be very clear about what kind of downside protections you have. If you're investing in preferred shares, what kind of liquidation preference you might have. If you're investing in common, what kind of preferences do you have there? You won't have any downside protection there, and so you want to flag that and say, hey, it's just common. Now, there could be so there's interest. You're not going to get paid interest. And sometimes they'll list dividends, but those dividends are if and as declared by the board, which never really happens. So they're a bit of a distraction more than anything else. The last thing you have is there could be a bunch of other terms that are important to you. So we talked about some of those control provisions. You could have buyback rights, drag along rights, some of those other things. Those are less important for this competition unless there's one that really stands out and was flagged. And if you have any questions about that, feel free to reach out to us, and we're happy to talk you through whether or not it's a super relevant term. All right, so that's equity. If you're not going to invest in equity, then you're probably going to invest in convertible debt. Now, convertible debt is debt that can convert into equity. And here's the thing, as a venture investor, you never want to be sitting on just debt, because the way debt works, if we go to the last column for a moment, you're basically just lending, well, you're lending somebody money, right? They're borrowing the money, and their obligation is to give it back to you at some future date and then compensate you for letting them borrow it, right? It doesn't give you are not an owner in the business. You don't get to participate in the upside. All you get to participate in is that fee, that rental, essentially, that rental fee on borrowing the money from you, also called interest. So the flip side, though, is that if a company goes out of business, they are obligated to give you back that money because it's not their money. They were just borrowing it, right? So you have a first lien, as we call it, on the business. And so, in our prior example, if I lent the business $1 million, it really doesn't matter for how much they sold. They can sell for $1 million, they could sell for 100 million. They would still be obligated to pay me back my $1 million first before anybody else got anything, right? Plus my interest, which is my compensation for letting them borrow it. And then, the other thing that you would normally want to be aware of is like, what's the term of that loan, right? What are the terms? Is it a 5-year loan? Is it a balloon payment? Is it interest only, right? What are the general terms of that debt? Now, in this competition, we're not going to really deal with debt. So, just kind of file that away. But it is important to understand how debt works so that when you look at convertible debt, you understand kind of the convergence of equity and debt and how that comes about. So with convertible debt, you're not going to have a true valuation because you're lending money, right, to the company. But your goal is for it to convert into equity because you really want to be an owner. You want to capture the upside of this investment, right? You're not in the business of making loans. And so you're going to put some sort of valuation cap on the business, hopefully, right? Or one will exist. And the reason for that is because part of the reason that you do convertible notes is because you're not exactly sure what the valuation of the business should be today. If it's a bunch of guys in a garage cranking out the next great software or search engine, you don't know that it's going to be Google, right? If you knew that it was Google, then you could probably put some sort of valuation on it. But because you don't know it's going to be the next Google, you kind of kick the can down the road until they actually build a product and start selling it, and you've got enough data points you could actually put a valuation on the business. So that might be why you do a convertible debt, or what's called a SAFE, which is just essentially it's another form of convertible debt. But you also want to put a cap on the valuation, because the last thing you want to do is come in and take all of this crazy risk, right? Back, giving these college students in a garage a bunch of money, and then it does turn out to be the next Google, and they raise it like a massive valuation, and your debt converts into equity at that valuation, and you missed all of that upside, right? You took all of this risk and you didn't get compensated for it at all. So that's why investors will oftentimes put a cap on the valuation and say, hey, if you're wildly successful, my investment, when it converts from debt into equity, shouldn't convert at a valuation higher than this cap. So in our prior example, maybe I say my valuation cap here is $10 million. Or maybe I say it's $15 million whenever it is you get around to raising more money. So what happens is the company will raise the convertible note or SAFE, and then they'll use that money. Maybe they raise $1 million and they use that money to build the product and start generating sales. And then once they've got enough traction, they'll go back out to investors and they'll raise equity. And those equity investors will set a valuation, a pre-money valuation, right? Like we just talked about. And all of the people that are in the convertible note will convert from debt into equity. And they'll do it at either the valuation that was set by the equity holders minus some discount, or at the cap. So if the cap is $15 million, but the company ends up raising in a $20 million valuation, your investment in the convertible note would convert as though you had invested at a $15 million valuation. On the other hand, maybe your convertible note comes with a 20% discount. And so, and a 20% discount and or a 15% cap, valuation cap. Well, in that case, if the company raises at a $10 million valuation, that's under the $15 million cap. So then the discount comes into play, and your investment would convert as though it had been made at an $8 million valuation, because that's a 20% discount off of $10 million. Hopefully that makes sense. So those are the things that you're looking for: valuation cap and your conversion discount. Now, there are some other terms. You could have what's called interest, paid in kind interest. If it's a convertible note, it will probably have interest, a PIK interest rate. If it's a SAFE, it won't. Under a convertible note, a PIK or paid in kind interest is simply interest that, rather than write you a check for the interest payment, they're just going to increase the debt that they owe you that will eventually convert into equity. So if it's 10%, you put in $1 million, a year later, your $1 million is now worth $1.1 million. And then when it converts into equity, it will be as though you invested $1.1 million instead of just $1 million. So that's how the PIK interest rate works. So if you're doing a convertible note, you're going to want to list the interest rate, as well as the valuation cap and the discount rate. If it's a SAFE, there probably won't be an interest rate. It'll just be a valuation cap and discount rate. Now, why would you do a convertible note? Like, one, like I said, you're kicking the can down the road on valuation. And two, because it gives you a first lien position. So it provides some really nice downside protection in the meantime. Convertible notes are very common whenever there's uncertainty around valuation. So the two places that shows up the most are at the seed stage, where it's too early to know what's going to happen, or between equity rounds later on in what's called a bridge financing. So a bridge financing occurs when a company has not quite yet achieved the milestones it needs to raise additional equity funding. And so there's questions around what the valuation should be. And so they'll do convertible debt as a bridge to give them enough money to finish up those milestones and go back out to market and raise equity. So, all right. I just dropped a whole bunch of stuff on you. Any questions on any of that? Everyone's got a crystal clear.
Does UGF exclusively do equity deals, or have you guys done convertible debt deals as well?
We have done convertible debt deals as well, but we will never do a deal that's purely debt. Ultimately, we are an equity fund. We want to be in the equity. We want to enjoy the upside of our investments. So, all right. If there are no other questions, we'll move on. All right. So, management. Question for y'all. Do you back the horse, or do you back the jockey? What do you think is more important? The team, or in this case, like the market? Or the business idea? It's a great business idea. That's what you're really investing in, or are you investing in the team?
The team.
Why do you think the team, Evan?
I mean, I'm just looking at this horse here, and I can't help but think, if he gets run into a wall, he might be the strongest horse in the world, but he's not going to be going anywhere. You need somebody to steer the ship. You need to have strong management that has a vision, that has that background, like we were talking about in prior conferences. Yeah, the team, the vision, their experience, their ability to adjust to changing information. I think that's far more important. I mean, I think obviously the vehicle is important as well. I mean, obviously, but I would say I would argue that the team's more important.
Okay. Anybody have a dissenting opinion or alternative viewpoint?
Yeah, I have one.
Go for it, Jack.
I mean, the jockey's great, but at the end of the day, if the horse wants to take control, it's going to, and the jockey only has so much power over that. So I think looking into the markets and realizing the trends at the end of the day is the more powerful vehicle here, just because there's only so much a team can do if the market's running a certain direction.
Okay. So I think you're both right. I think both matter. It's the horse and the jockey together, right? In unison. But what does that mean in terms of how you evaluate management teams? So the thing that I like to think about when I'm evaluating management team is spending time understanding the business, the customers, the pain point, what needs to be solved, the overall market, right? Really understanding that, and then looking at the management team and asking yourself, is this team the right team for this business and this market opportunity, right? Are they the ones that can go out and make this thing a success? And some of that is just generally evaluating entrepreneurs and understanding, is this a good entrepreneur, broadly speaking? But some of it, you can have amazing entrepreneurs that are not able to really run a company and take it where it needs to go if it's not the right company for them, right? You wouldn't take somebody like Mark Zuckerberg when he's in college at Harvard and stick him as the head of Salesforce, an enterprise software business, right? He wouldn't be successful despite the fact that he's a phenomenal entrepreneur, right? And vice versa, you wouldn't take Mark Benioff and put him at the head of Facebook, this social media company, and expect it to take off and be super successsul. So there's a certain amount of even though Mark Benioff is an amazing entrepreneur and executive, so there's a little bit about this idea of what I call it's not just what I call, but what the industry calls team market fit. Is this the right team for the market and the business, right? Do they have the right experience, the right temperament, the right ambition to really go after it and make it successful? Outside of that, there are a few other things you can think about. So do they have the right people given the size of the company? Do they have the right number of people given the stage of the company? The joke is that the number one killer of startups is premature scaling, right? It's where they think they've figured it out and they start spending money to grow and expand, but they haven't quite figured it out, and they get top heavy too quick and they run out of money and die. And we've seen that. We've seen companies where they're just way too big for where they are stage wise, and that's a big red flag around management and the team. The other thing to think about when evaluating management teams, when I'm going through it, is that there are going to be things that are specific to the business and that you're trying to figure out. So if I am doing a social, a consumer tech business, I probably want people that are younger and understand what younger generations care about and understand that skill set. But if I'm doing enterprise software, I probably want a more seasoned executive that's been out there in industry, that's dealt with the pain points that these enterprises have, understands not only the pain point, but how to sell into those companies, how to build teams that can build robust enterprise grade products, all those kinds of things. So maybe it's a much older executive or entrepreneur, right? So there's that whole like team market fit piece of it. There's also just kind of some table stakes things that you got to do your diligence on to make sure that you don't end up backing somebody that you regret backing. So that's where things like Glassdoor can be really helpful. If your company has been around long enough, has enough employees, you can actually look at things like, what's their culture like? What are the reviews? Do employees approve of the CEO? Those kinds of things. If you don't have Glassdoor, and even if you do have Glassdoor data, you might be looking in LexisNexis to make sure that the CEO hasn't been convicted of a felony or misdemeanor or something. You want to look and make sure that they're not in trouble with the SEC that would cause you any issues if they wanted to go public someday. You might look, we looked at a business once that we were really excited about, and then we just did a general internet search and we found this woman that had written this huge long blog post about how the CEO had like sexually harassed her multiple times, and she was trying to get the word out there that he was like not a trustworthy individual. And so we saw that, and that led us down this rabbit hole of finding out that it was actually true, and then we passed on that investment. But we would not have known that if we had not spent the time doing our diligence to make sure that he was a trustworthy individual. So it's worthwhile looking for those types of things. If you can find reviews, look at the good and the bad reviews. Try to get a feel for what's real. Look for info regarding kind of the management, the direction they're taking the company, the culture, and be cognizant that like some culture, like it's okay to have a hard charging culture, right? Apple under Steve Jobs had a very hard charging, tough culture, and that allowed them to become what they are today. Other companies like Google had a different culture, right? That was more collaborative and innovative, and that has served them well. But you got to understand like what is the business and what are they trying to do, right? Same thing with like Uber and Lyft. Uber had a very kind of arrogant culture that was like, hey, we're going to just go out there and we're going to like bang down doors and we're going to do things even if they're technically illegal and whatever, but like that's how we're going to make waves and build our company. And Lyft had a very different, culture, and both cultures worked well for those companies. So, spend some time really understanding like the company and what needs to be achieved, and is the culture helping them along that path, or is it ultimately going to hinder them? You might also have a company where a hard charging culture is going to be a real problem because it's going to result in higher turnover, and they're not a company that can afford to have high turnover, right? Another thing to look for turnover, not just of kind of your foot soldiers, but look for turnover of founders, senior executives, those types of people. If somebody's leaving, that's usually a red flag, right? Especially if it's in the early days. It doesn't mean that it's a deal killer, but it could be that they banged heads with the CEO, and the CEO's, not listening to them and is just really hard to work with. That's going to be a red flag, right? It could be that co-founder was not the right person and had to be let go, in which case you should be asking yourself, well, they probably took a big chunk of equity with them. So do we need to be worried about that, right? There's always going to be like, that should always be a red flag if somebody leaves, that you want to at least dig into a little bit to try to understand what happened. All right, so going back, hang on. I think I'm losing my voice. Hang on a second.
All right. In the meantime, does someone want to tell us a joke? Oh, here he comes. Save it for next time.
Hey, sorry about that. All right. So management teams, make sure that like they have the right people for what they need to accomplish, right? Make sure that the people that they have are like good people. They've got a good culture, and that they've got the right experiences to really help the company succeed. And if there are holes, like don't be afraid to say, hey, like this company, they're really going to need a great salesperson. They don't have that person yet. It's okay to flag that as a hole, because part of the reason that they're raising money might be to go hire that person, and that's okay. But it's important to know kind of where the holes exist. All right. Any questions on management team before we move on? All right.
Hey, Peter, I actually did have one question.
Yeah, fire away.
Because it's come up a couple different times, like with other venture firms I've talked to recently, how like some venture firms have like a thesis on age. Like we don't invest in entrepreneurs like over the age of like 30 or whatever it is. How does UGF feel about it? I know you've kind of talked on both sides of the coin, where it's like you have to experience the pain point, but also it's not bad to have like that high energy entrepreneur that is younger and willing to take risks. It's like, how does UGF kind of look at age?
I mean, outside of somebody that's like, you know, in their like 70s, and somebody that's like still in high school, I don't know that we particularly care about age, you know, just age is a number. But I do think that gets back to, like, do they have the right experience or the right perception or mindset for the business that they're in, right? I wouldn't hire somebody that's super old to build an app that's made for like, you know, teenagers and vice versa. I wouldn't take somebody that's like, you know, 18, 19, 20 and trust them to build a super robust enterprise software application, right? So look, we've backed people in their 60s. So the CEO of Enjoy, I think was in his 50s or 60s when we backed him. And we've backed other entrepreneurs that were in their early 20s. So yeah, we don't have a hard stance on that. There are great entrepreneurs at every age. I mean, heck, my grandfather's, I think he's like 85, and he still goes in and sells hearing aids every day because he loves it. And he's, I think, like the top selling hearing aid audiologist in Utah County. So go figure. All right. So let's talk a little bit about financials. I understand that getting access to financials might be one of the hardest parts of this competition. I still want you to try really hard to get what you can from for financials, or at least something that indicates like level of traction. Because again, that's going to be a strong indicator that if you could convince an entrepreneur to give you that, if you had had an actual fund, you probably could have convinced them to let you invest, right? So let's talk a little bit about the basics of financials, since I'm assuming not all of you are finance students. So the most important one that we're going to care about for this competition is your income statement. Now, the income statement is a representation of a period of time and how the business performed during that period of time. So it starts with revenue, and that's the total money that you received for providing a good or service. After that, you've got the cost to provide that good or service, and that comes out first, and then that gives you your gross profit. So in this case, we have revenue of $100. It costs us $25 to produce the goods that we sold for 100. And so our gross profit is $75 and gives us a gross margin of 75%. Theoretically, your cost of goods sold are variable with your revenue. And so, you know, the more you sell in revenue, the higher your cost of goods sold are, and your gross margin remains relatively stable or constant. Now, over time, what happens often, especially in venture related deals, is that with scale, they actually become more efficient and gross margins actually improve. In less scalable businesses, the opposite is actually more likely to occur. After your gross profit, you get down to your operating expenses. These generally are more fixed, although not always. Like marketing expense is oftentimes going to be tied to revenue, because the more you spend on marketing should result in more revenue if you're doing a good job in your marketing. But it's not a cost to actually produce the goods, so it falls into the operating expenses. Other operating expenses could include your admin, your salaries for employees, your sales expense. It could include like rent, office supplies, all of those different things that are included in just like, we have a business and it's operating and we have expenses tied to those operations. After you subtract out that, you get EBITDA, which is earnings before interest, taxes, depreciation, and amortization. This is a representation of the cash flow of the business. So after I subtract, if I take my revenues that cash that came in the door at the top, subtract out what it cost for me to produce those goods, and then I subtract out all of the costs related to operating the business, that leaves me with cash that theoretically I could do a lot of different things with. And EBITDA ends up being a great way to compare one business to another based on the cash that it's generating. Now, an income statement is not necessarily cash-based, which is why you often have a statement of cash flows. But generally, in the long run, all things being equal, it is going to be largely related or highly correlated with cash. So EBITDA can be an incredibly helpful number when you're trying to evaluate, you know, the cash efficiency or how well a business functions. After that, you take out interest and depreciation. So interest is what you're paying on your debts that you owe, and depreciation is the expense that you're taking out for how much of different assets that you've used up. So if I bought a big piece of equipment and it's going to last me 5 years and I used up a year of its life, then I would depreciate 1/5 of the value of that asset, right? Because I used it up theoretically, right? So it should be subtracted out. Now, it's not a cash expense, and so it doesn't show up in operating expenses, but I still need to take it out before I get to net income. Largely because I want to not have to pay taxes on that expense that was used up. And then I get to taxes, and I have to pay my taxes to the government if I actually generated income. And then that leaves me with net income and my profit margin. So that's the basics of an income statement. Pretty simple. Hopefully this wasn't horribly boring for those of you in finance, and hopefully makes sense for those of you that are seeing it for the first time. Now, in terms of this competition, you might only get like revenue or some indication of revenue. If you can also figure out or at least estimate what your cost of goods sold are, that can be really helpful, because you'll want to try to get an idea of what gross margins look like. In venture, it's really important that companies have high gross margins. And the reason for that is really twofold. The first is that if you have high gross margins, it means that you have more cash to reinvest in your business. If I have, 75% gross margins, well, Well, that means in this case, like that's $75 that I can use to cover my operating expenses, to reinvest in like things like marketing and sales, and really try to grow the top line of my business. If my gross margins were only 25%, then that would only be $25 that I could use to do all those things. And that makes it really hard to scale as quickly as a business that has high gross margins, right? So that's why that's one of the reasons, at least, why it's really important to have as high of gross margins as you can, is because it gives you more capital that you can use to grow. The other reason is that other investors recognize that value, and valuations are based on cash coming out of the business, profits that investors can put in their pocket. And so if you have a business that is higher gross margin, and you believe that gross margin is, well, cost of goods sold is a variable expense, then as the company scales and gets bigger and bigger and bigger, more of that cash flow should cover the relative fixed expenses of operating expenses and should flow down to investors' pockets. And because of that, they're more willing, or they put a higher value on businesses that are high gross margin. And so they demand a higher valuation. So those are things that you want to be looking for. You want to look for businesses that are going to have high gross margin, because it usually means that they're more scalable and they'll have more money that they can deploy in scaling the business going forward. And future investors will place a high value on that and give you a good valuation when you're ready to exit the business. Now, not every business is going to have high gross margins in the early days. Like I said earlier, sometimes it takes companies a little while to figure out and get scale so that they can drive down gross margins. So part of the exercise here is just try to figure out where gross margins are today and where do you think they will be in the future. So I'll give you an example of that. When we invested in Lyft, they had negative gross margins, which meant on every ride that people took, Lyft lost money. And so you could look at that and be like, well, that sounds like a terrible business, because the more rides that we offer, the more money we're going to burn. We're never going to make it up at scale, right? But why was that? Well, the big reason was that Lyft was discounting their rides by a lot because they wanted to get people on the platform and trying out the product, right? They were trying to change customer behavior. And so for them, it was like, hey, yeah, we're going to give away dollars for 50 cents here, right? You give us 50 cents, I'll give you $1, right? We're going to do that because it's going to convince people to at least give it a shot, right? Convince people to get into a total stranger's car and let them drive you around for 10 to 60 minutes, right? And not get over your fear that they're going to kidnap you and kill you, right? So they were willing to do that, but over time, people then began to trust and change customer behavior. And now Lyft does not provide discounts, right? In fact, they've increased prices and they generate significant gross margin on every ride that they offer. So it's okay, but in the early days, if gross margins aren't the highest, but you got to be able to believe that there's a plan for them to get there in the future. All right. So once we understand kind of the basics of financials, it's helpful to look back at the past at companies. So you're probably investing in companies that are at the seed stage. They probably don't have a lot in terms of revenue, but what you're looking for is, have the financials shown that they've figured out or proven something about their business, right? So if you think about startups, the difference between a startup and a company is that a startup is still out there trying to figure out the business model that's going to work. And a company is one that's figured that out and they're just operating the business model. So financials can be a really good way for you to gauge what have they figured out versus what have they actually proven, right? If a company has a thesis that like, hey, people are really going to like playing VR racing games, right? That's our hypothesis. then what you'd want to do is you'd want to look at the financials and other metrics to determine if if they've been able to prove that that hypothesis is correct. And if they're selling a lot of their product and people are buying it and not returning it and are excited about it, then that's pretty good indication that they've figured out or proven that people like that, right? If, we just made an investment in a company called Gorillas. And what Gorillas does is it's very fast delivery of convenience store items. So you want a Diet Coke in Gorilla, if you lived in one of the cities where Gorillas delivers in Europe, they could get it to you in 10 minutes, right? And charge you like $1 for the service, $1 or $2 for the service. So the thesis there was people want, products delivered very quickly, very convenient, right? Like they want the convenience that offers. And when we looked at the numbers and the financials, what we found is that one, their NPS scores, which like their customer satisfaction scores were incredibly high, but more important was that people would buy and then they would come back and buy again, and they would buy more, and then they would buy again and buy more. And so over time, people kept coming back and buying more and more and more, and again and again and again. And so that became a really strong indication that like, hey, they're not just providing a service that people want to use once, they're providing a service that's changing how people buy, period. It's changing behaviors, right? So that's the kind of thing you want to be looking for, right? Are people, if it's software as a service, are they buying, are they renewing, and are they spending more when they renew, right? It's like, hey, this product is so good that we need to bring even more people on board to use it. Are they growing quarter after quarter, year after year, month after month, right? You want to be looking for companies that have consistent growth, because it means usually it's a good sign that customers really like the product, and they're almost, if the growth is high enough, they're desperate to have it, right? So good, like quarter over quarter growth is probably like anything in excess of like 20%. Well, not on a quarterly basis, on a monthly basis, like 20% month over month growth is probably pretty strong. And the higher it is above that, the more interesting it gets. You want to look for at least 100% year over year growth. I would say any business that's growing at under 100% year over year at this stage is probably not that interesting. A lot of the companies that we back at this, when they were at the seed stage, they were growing like 200, 300, 400% year over year, to give you an idea. And they will often continue growing at 100+% year over year during the time that we were investors. The next is to really spend some time, if possible, if you can get the data, understanding the unit economics and key drivers of the business. So we talked about Lyft, right? Lyft was losing dollars on every sale, on every ride. Well, it's helpful to, if you can, get that data to dig in and really understand how much money do they make every time they sell a product or service. How will that evolve over time? And do you believe the story, if it's negative, that it can turn positive, right? And then can you articulate that to the investment committee in a way that's believable and defensible? The other thing that's helpful is to understand, like, what are, like, if you understand the business model, what are the things that drive revenue? So that could be marketing dollars. The more dollars that we spend on marketing, the more customers we get. It could be driven more by sales reps. The more sales reps we have, right, the more sales we're going to be able to generate. It could be partners. So we invested in a company called Tiled this year. They have a handful of really strong partners. And so we spent a lot of time really understanding those partnerships, because those partnerships are huge drivers of revenue to the business. It could be on terms of number of users. So not users that are paying for the product necessarily, but this could be like Facebook has a lot of users. The more users they have, the more advertisers want to advertise on their platform. And so that can be an important driver of revenue. The number of transactions that happen on the platform. So we're an investor in Toast. I'm sure all of you have used Toast when you've gone out to eat because they're so ubiquitous now. Toast makes money on the transactions. So whenever you buy food at a restaurant that uses Toast, Toast is taking a cut of that transaction. And so, yeah, they have sales reps, and those sales reps sell their software and their hardware and everything to restaurants. But the big driver of the business is how many times people go to those restaurants and order food. It's the number of transactions that drives revenue. So you want to understand what are those key drivers of the business. The other thing that I oftentimes see is once you've understood the business model, what drives revenue and growth in that business model, then you want to start projecting out the future, right? You want to be able to say, hey, we believe credibly that this company will someday generate 50, 100 million, whatever that is in revenue. And you want to be able to tell a story of how they're going to get there, right? Now, ideally, the company provides you with some of that guidance, but it's going to be tied back to what those key drivers are. One of the mistakes that I see students make consistently is not stepping back once they project everything forward and really thinking about what they're implying with their growth rates. So sometimes you'll see like the companies growing at increasing growth rates. So they did 100% year over year in year one, and 200% year over year in year two, and 300% in year three, or something like that. That doesn't make sense, right? It's a lot easier to grow 100% when you only have $1, because all you have to do is get one more dollar. It's really hard to do that when you've got $1 billion, because you got to go find another $1 billion in revenue to grow 100%, right? So generally, growth rates decline over time. So maybe it's 100% and then 90% and then 80% or what have you. So make sure you don't fall into that trap. Look back at your growth rates and make sure that they make sense. And then make sure that like your underlying drivers also make sense, right? Like, am I really going to be able to add, if sales reps are what drive my revenue, am I really going to be able to go from 10 sales reps to 200 sales reps in a year and have them all perform at the same level as those 10 sales reps did? Probably not, because it takes time for sales reps to get onboarded, trained, scaled up, and then some of them won't work out. So you're going to have to fire them and find new ones, right? There's going to be like big sales efficiency issues that you got to deal with. So be thoughtful about how you're projecting things out, so that you can adequately defend them to the investment committee and not get tripped up when they point out something like that, right? They're like, what you're implying from a marketing efficiency perspective is that over time, they'll be able to acquire more customers per dollar spent on marketing, which usually is not how it works. Usually, as you spend more money on marketing, it's harder and harder to convince people and more expensive to convince people to try your product and use it, right? So just double check all those assumptions and make sure that they logically make sense. All right, so this is just basics on unit economics. The general idea is, what's the revenue from one unit sold? What's your cost of goods for that unit? That is going to give you like gross profit on a per unit basis. And then you should also be taking out your cost to acquire that customer. And when you take out that plus any other variable expenses, that's going to give you contribution or contribution margin. That's actually the money that can be used to offset your operating expenses. And so kind of walking through this can be really helpful, because oftentimes companies will be like, oh yeah, like on a unit basis, we have 50% margins, but they're not taking into consideration either all of their variable expenses or they're not taking into consideration their cost to acquire a customer. So that's particularly the case. Oops. That's particularly the case if you're selling an actual product and you don't have any sort of recurring revenue. If you're looking at a software as a service business, the beauty with that is that the customer, you don't just acquire the customer every time you generate revenue. You only have to acquire them once and then they keep coming back. So in that case, you want to look at lifetime value, because you could say, well, what if I generate $100 in revenue, but it costs me $300 to acquire them in year one? Well, that doesn't sound like a great business, right? I'm going to lose $200 on that customer. But if they come back the next year and the next year and the next year and the next year and the next year, then maybe it actually is worthwhile to spend $300 to acquire that customer in year one, right? Because I'm going to generate maybe 10 years of value from that customer at $100 a year. That's $1,000 of lifetime value from that customer. And it only cost me $300 to acquire them. So I'm getting an LTV to CAC ratio of 3.3, right? Every dollar I spend on marketing, I'm able to turn into $3.3 worth of revenue. Then you still need to take out your cost of goods sold and any other variable expenses, right? So in that case, my contribution margin here is $500. Because I'm starting with 1,000 over the lifetime. My cost of goods might be only 20%, which is another reason why high gross margins are important, right? Because that's only, it's 20% cost of goods. That gives me $500 after I take out my cost to acquire. So at the end of the day, like, that's $500 of contribution margin over the life of the company or the life of the customer. That might be worthwhile to look at. So, and worthwhile to spend money to acquire that customer. So just kind of thinking through, like, the lifetime value can be really helpful in justifying like higher spend in the short run. And by the way, that's part of the reason why companies will be highly unprofitable for a long time. And they raise lots and lots of money, is because they're trying to acquire customers as fast as they can. And they know that those customers will be wildly unprofitable today, but will be extremely profitable in the future. And so that's why it makes sense for enterprise software companies to burn a lot of money acquiring customers, is because the lifetime value of those customers can be extremely lucrative. All right, so we talked a little bit a couple slides ago about projections. Honestly, you don't need to have super detailed projections for this competition, but you should have kind of top line revenue, and you should understand what are the drivers of that revenue and be able to explain what they are and how that's increasing. So in this case, it could be like revenue plus marketing spend, right? Because we believe, like, for every dollar we spend in marketing, it's going to generate this much revenue. And again, just be able to defend kind of your projections and how you got there, whether it's marketing spend or number of sales reps, or transaction volume, or whatever it might be, or number of users. Be able to kind of show the correlation between those drivers and your top line revenue. All right, any questions on that? Cool. Let's talk about the good part, getting your money back, plus some, hopefully. So exits and returns analysis. So in venture capital, we require liquidity events because we're investing other people's money and they want that money back plus a return. It's not free. So those liquidity events, there's basically 3 liquidity events. You get acquired by somebody else, you take the company public, or you file bankruptcy. We're hoping to avoid the last one. So I'm hoping that none of you pitch bankruptcy as an outcome here. So you're going to end up pitching M&A or IPO. What you need to be able to do is decide which one is most likely for your company and why that's really the optimal outcome. So I've got a few examples here. It's actually interesting because one of these examples I put on here because I thought, well, I knew it could go either way. So how many of you are familiar with ClassPass? Anybody know that company? Yeah, I mean, it's the pandemic really did a number on it. But for a while, it was a real high flyer and fairly well known, pretty big brand. ClassPass, what they do is back in the day, in the prehistoric, pre-pandemic days, they had fitness classes. So you could go do yoga, you could do spin class, you could do whatever. And what ClassPass did was basically say, hey, sign up with ClassPass and then you can get access to all these fitness studios and go try them out. So that was their business model. And they worked with, I mean, I think their market share is pretty tremendous. Like at least like 50-60% of all fitness studios out there across all different kinds of fitness, like worked with ClassPass at one time or another. So you look at a business like that and it's like, well, if they can keep getting more fitness studios and then they can get more people on the platform, like this, from a revenue perspective, they should be able to generate lots of revenue. They could probably get to $100 million revenue threshold, which is generally what you need in order to go public. Now, the flip side is all these fitness studios, they all use a company called Mindbody to manage all of their scheduling with people that want to take those classes. And so ClassPass was highly integrated with Mindbody, and lo and behold, they just announced a few weeks ago that Mindbody has acquired ClassPass. So in that case, ClassPass could have gone either way. You could have made a strong argument that like, hey, they could have scaled up to 100 million and gone public, and then scaled beyond that. Or they could get acquired by Mindbody, which is ultimately what ended up happening. You look at a company like Health Catalyst. Now, Health Catalyst, they're a Utah company, and they do database and analytics for healthcare systems, and they sell their software as a service, and they sell it to large hospital systems. So for Health Catalyst, right, that's a business that was doing well in excess of 100 million in revenue. There are likely some buyers for it, but not many. And it's a great company that could go public, and sure enough, it did go public a number of years ago. You contrast that with a company like ScoreStream. So what ScoreStream does is they have tens of thousands of users. Actually, well, they actually have over 1 million users across the country. And those users, a subset of those users, kind of tens of thousands of them, create content on the ScoreStream platform at high school basketball and football games. So you're at the football game at a high school in Texas, there could be a few people in the stands that are recording parts of the game, taking pictures, posting the scores, all of that onto ScoreStream. It's all user-generated content. And if you don't live in Texas and you can't go to that game, but you're a huge fan of the football team because you played on it when you were in high school, but now you live in California, you can hop onto ScoreStream and you can get live updates on what's going on with that football game. So that's what ScoreStream does. They have, like I said, 1 million+ users that are active on the platforms, reporting scores and pictures and so on and so forth. What do you think? Do you think this is the type of company that gets acquired? Or do you think it's the type of company that ultimately goes public? Any thoughts? Well, I'll tell you right now, they're not generating 100 million in revenue. How would they generate revenue? What do you think the business model is here?
I have an idea.
What?
Generate enough users to attract maybe some other like recruiting databases for high school athletes, or maybe like an ESPN type company that can use their platform to reach new users and integrate it into their own system.
Okay, how does ESPN make money?
Through advertisements.
Through advertising, right?
Yeah.
So ScoreStream's got an audience, so they could monetize through ads. They also have data, and they could sell the data, right? So theoretically, like maybe if they tapped like every single sport that's out there and game that's going on, they could get a large enough audience to generate meaningful enough revenues that they could maybe hit that threshold. But I think it's probably really tough. Flip side is there are probably a lot of companies that would be interested in the data that they're collecting, right? Like an ESPN. And so for ScoreStream, it's probably most likely they get acquired by a company like an ESPN, or maybe it's like from a Google or somebody that puts a lot of value in data and can monetize it at much higher rates than ScoreStream can, right? So in that case, ScoreStream is probably a much better acquisition target than it is an IPO target. All right, so you need to think about your business. Is this the type of business that's a standalone business? It can get to 100 million revenue plus and continue to grow from there. In which case, it probably is the type of business that can go public. Or is it something that really would fit better within a larger company and add a lot of value to that company? And that's okay too. Not every company needs to go public for VCs to have great, successful outcomes. I'll tell you what, like in some ways, I would rather sell a company through an M&A process, because then I don't have to worry about how the public markets are going to go up and down and value it differently every single day, right? So Toast, one of our investments, they just went public a month ago, and like it stresses the crap out of me because we can't sell yet. We're locked up for 6 months, which is pretty common. And so every day I just look at the stock price. Is it up? Is it down? I don't know. Like, there's nothing I can do about it, but if it goes down, it hurts our returns. But if it goes up, it's exciting. But I would rather have just sold it when it went public and been out and done and not stressed about it every day. So it can kind of cut both ways. All right. So I just want to touch a little bit on valuation and comparables analysis. So one of the things you're going to have to figure out after you figure out, like, what's the exit strategy? Who's going to buy this? You got to figure out valuation. Now, for you guys, valuation is probably going to be set, right? You're looking on WeFunder, for example, and they already give you the terms, right? This is the valuation. What you need to figure out, though, is what's the valuation going to be like in the future, and what kind of return could you generate from it? So what I recommend for this case is to do comparables analysis as opposed to a DCF or what have you. And the reason for that is because you're not likely to get robust financial data. And even if you did, you would have to build out like a DCF that goes out, well, probably well over 5 years, in which case, like, it's like kind of like, I think it's, I've got all of these different variables I've got to adjust, I've got to control for, and it's just really hard. So comparables analysis is great because it allows you to piggyback off of thousands, tens of thousands of other people that are actually doing DCFs on businesses and give you an idea of like what kinds of ranges investors are paying on a valuation basis for companies. So how do you do, at least first, how do you think about comps analysis? So I like to think about it like real estate. If you think about how houses are priced, it's based on number of beds, baths, location, finishes, how many garages, the HVAC system, what amenities they have, school district, how safe the neighborhood is, the color of the building, how much maintenance is required, what's going on in the overall market, et cetera, et cetera, et cetera. It's all of these different factors, right? And that's how you put a price on it. So you could sit down and say, okay, well, we have this many beds and this bath and this location, and you try to come up with a value for each one of those things and add it all together. That's really hard to do. So what do realtors do? They're lazy. They do the shortcut thing, which is they basically say, okay, I'm going to find a house that looks as close to yours as possible. Or I'm going to find a handful of those. And then we're going to price your house somewhere in the same range, right? So that's basically the same thing you're going to do with a company. You're going to go out and you're going to try to find companies that are relatively similar. And you're not going to find one that's exactly the same. And the more disruptive and innovative your company, the harder it will be to find companies that are the same. But, you know, do the best you can. Your ideal is just like in this picture where all those houses look exactly the same. You want to find the house that looks like, if you're selling this house, you want to find out how much this house sold for like yesterday for the same reason, right? That's the ideal. And that's what you're shooting for with your comps analysis. I will tell you right now, it is better to have fewer comps that are high quality than lots of comps that are low quality. So it's worthwhile spending the time to find good comparable companies. So this is a table that I pulled this straight out of our investment memo in an investment we made in a company called Quantenna. Quantenna made high performance Wi-Fi chips. They are fabless semiconductor business, which means that they designed the chips, but then they had them manufactured elsewhere. And our team, I think, did a fantastic job of identifying similar companies. So with the exception of one of them, none of them does Wi-Fi. And that's okay, because what we were looking for was fabless semiconductors that were leaders, like innovation leaders in their industry. And those industries are relatively similarly sized, and the companies were about the same size. So Ambarella they were a leader in video compression and imaging processing chips for video. Avago did stuff for fiber optics, if I remember correctly. Cavium did chipsets for routers and video storage. MPS did it for analog and mixed signal chipsets, and then Skyworks did it for radio in mobile devices. And they were all kind of leaders within their field. So, you know, first we kind of broke those out, identified those companies. Then we said, okay, what are the sizes? So Quantenna at the time, we believed by the time they went public, they'd be worth about $1 billion, which ended up being true. And so these companies, right, this one's worth 1.5 billion, 3.2, 1.8. Avago is a little bit of an outlier at 30, and Skyworks is a little bit of an outlier at 12, but they're all like, you know, in those billions range. And then we looked at like their revenue over the last fiscal year, and their EBITDA, and then we came up with our multiples. So we looked at the enterprise value today relative to how much revenue. And if you look here, part of the way you know that you're doing a good job is if all of your multiples are in a similar range. So here they're all in that kind of 5 to 9x range. And we also looked at revenue growth over the last couple of years, because our company was growing, I believe it like 40 or 50% year-over-year growth we anticipated by the time they went public. And so, you know, we would probably weight some of these companies that are growing a little bit faster, like an Avago or an Ambarella in their comps, than we would companies that were growing slower, for example. And so through all of that gave us a multiple of 6.8x that we could use to multiply against our revenue and give us an idea of what the valuation should be for Quantenna. And basically you want to try and do the same thing. If the company is generating positive EBITDA, then use EBITDA multiples because they'll be better. But my guess is that most of the companies you're going to look at are not profitable yet, but are rather growing really fast, in which case you're typically going to look at enterprise value to revenue instead. So if you're doing your exit strategy and projected returns, first step is to forecast your financials, right? So forecast out at least revenue. Find your comparables in your multiple range, right? So go down to our comparables thing, and you have a breakout of enterprise value, your revenue, and then your enterprise value to revenue. Then you're going to apply that multiple to your forecasted revenue. So in 2018, it's $8 million times 2.8x. That's going to give you your implied exit value. You're also going to have an investment entry value, which if you look in our returns analysis, our post-money valuation of $3 million. And then in 2018, the we were $22.6 million. That represents a 7.5x, and over that time period, a 96% IRR, right? Now, in your case, this is just a simple spreadsheet, and we will send this spreadsheet out to all of you. So you have a basic template that you can use. In your case, you're probably going to be shooting for higher returns than 7.5x. You probably need to be pushing for at least 10, 20, maybe even 50x returns. And so this is where it's valuable to basically say, hey, look, if everything hits perfectly with this business, it has the potential to get to a 50x return or whatever that return might be. Now, it's not likely, and it's highly risky that won't happen. But if you can explain logically how that's possible, that's what you need to do as a seed stage investor, right? You got to be able to make a credible case that it's possible. And then show us, the projected multiple and IRR and cash return on your investment of what you project. Any questions on that? Hey, Rocky, do you have this spreadsheet that you can send out?
Yeah, I can find it. Send it out.
Let me know if you don't have it. I can get it to you.
Sure.
You don't have to use a spreadsheet. It's just a really simple template if you want to use it, so you can see how it all flows together. All right, and that brings us to our investment thesis. Your investment thesis is like your elevator pitch on why you want to do a deal. So you should explain what the company does, the market size and trends, why the company will win in that market relative to the competition, the historical traction and performance, what potential returns you anticipate, and why it fits for your fund, right? If it's going to generate a 2x return, that may not be a really great fit for a seed stage fund. So you got to be able to explain why it fits for your fund and your strategy. We'll give you some leeway in terms of how you define your strategy. And then your recommended investment amount. Is it $1 million? Is it $500,000? Is it $5 million? Whatever it is that fits kind of your fund strategy. And then I always highly recommend that you break out like what are the key risks and the mitigating factors of those risks. So here's a tip when doing case competitions. If you want to win competitions, you identify the other possible solutions and you write them off out of hand. You explain why they won't work. What that allows you to do is you can take the solutions that your competitors are going to throw up and explain why they're the wrong solutions and why yours is the best one. And if they don't do that as well, it puts you at a massive advantage. In terms of this case competition, you're going to want to identify what those risks are, because I guarantee you the investment committee is going to identify those risks. And if you can get ahead of their objections by saying, oh yeah, we know this is a risk, here's how we think it's mitigated, you can kind of stop that entire conversation and right at the get-go. So highly recommend understanding that every business has risk. If there wasn't risk in the business that you're pitching, then it probably wouldn't be that interesting of a deal to do, because everybody would know that it's going to be a great deal because it has no risk. and then the valuation would be pushed up super high, and then it would be hard to generate a great return on it. So, and you definitely see this in companies. Like there's a company we talked about called Pipe, and Pipe raised at like $1 billion in valuation on like $1 million in revenue, right? Because everybody looked at it and they were like, yeah, this is like a no-brainer. This is gonna be super successful. Valuation got pushed up so high. Like, I think it's tough to get a massive return on that investment now, right? So risk is not a bad thing. You want to kind of be risk loving in venture. You just want to know what risks you're taking, be comfortable with that, and have like some sort of mitigating factors that keep you from getting burned on risks that you didn't anticipate. All right, so just to cover everything again, for your write-up on your investment analysis, your presentation, you need to cover the business model and strategy. What's the pain point? Who's the customer? How's the company solve the pain point? How does the company make money? You got to hit the market. So how big is the market? TAM, SAM, SOM. How quickly is it growing? What's driving that growth? Really show that you understand the market and its potential. Competition. Who are the top competitors? How is your company positioned against them? Why will they win? And why does where does your company have a competitive advantage? You need to hit on the offering. So what is the security you're buying and what are the key terms? You need to hit on the management team. So who are the key managers and why are they the right team for this company to be successful? Ideally, you've got access to some historical financials as well as financial projections. How's the company performed? What have they proven? What do they still have yet to prove? Understand what are the key drivers of that business? And then forecast financials. You probably want to have a base case and an upside case, right? Upside is like, hey, if everything goes well, we're all going to become billionaires, and a base case that's a little more conservative. And then your exit strategy. How do you anticipate exiting the investment? Is it going to be through IPO or M&A? And then what range of returns do you anticipate based on your base case and upside projections? And why do those returns fit for your $50 million fund and corresponding strategy? All right, so just hit on some dates. So your investment analysis is due November 5th. It's coming up fast. You basically got a week to get it done. We'll announce the teams on the 8th. And then the 5 finalist teams, we'll pair them with a mentor. The mentors are people that work at different venture funds and that have agreed to spend some time with our teams to give them feedback and help them out. And then we'll have our final event November 17th, where the finalists will pitch to the VCs. Any questions on anything that we covered this evening?
Will we be judged more based on our companies that we've chosen or our analysis and our slide decks, or a little bit of both?
It's about 50-50. So if you've got a killer company, but your diligence looks like garbage, not going to bode well for you. And vice versa, if you've got just amazing diligence, but your company, like, we can't figure it out and understand why it's going to be so great, you're not going to go super far either. So you kind of need both.
And then are we doing analysis for each of the 3 companies that we selected, or just for the major one that we're looking at?
Nope, just pick one.
Perfect.